Very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis. Myself with Giles Coughlin, Chief Currency Analyst. Very warm welcome. Lovely to have you here today. Looking forward to really making sense of the latest moves we've been seeing in the markets. Looking forward to cluing you into all that, exactly why, what's been happening. Also going to explain that move in gold, and particularly I'm going to teach you two things that if you don't know about flash crashes, you need to know, and this is the perfect environment to explain it to you. And finally, be focusing on the US CPI data this week, and that will be the main event, which on Wednesday I'll be getting folks ready for, so we can see what clear trading opportunities there are. And there are some pretty decent trading opportunities for the CPI data coming up on Wednesday, pretty much whatever happens. So there is further opportunities for US dollar Japanese yen trading into the CPI event. So I'll be outlining that. Very warm welcome to you all. Glad you could make it. Vitez, good to have you here. Zahir, a pleasure as always. Mohammed, Max, Eddie, Ibrahim, lovely. So I'm glad folks could make it. Thank you for taking time out of your busy day. So we'll make sense of what's going on now. I'm just going to quickly run through the disclaimer. Don't forget, as we talk about different entries and exits, this is not a signal trading service. The whole idea of this live market analysis is you look over my shoulders along with a professional trading background, you see how I understand the markets, and that helps you to make your trading decisions and growing your education. It's not a signal trading service. Those of you who are regular understand that. And obviously, the reason it can't be a signal trading service is because market conditions change. So the key is to understanding when market conditions have changed, and that's what we're doing in this webinar, showing you how to develop those skills for yourself. What we're looking at today, we're going to look at a few different things, and there are a few different opportunities. First of all, New Zealand dollar. We have had a decent shift out of the RBNZ last week. We had the news from New Zealand employment came in very low at 4% versus 4.5% unemployment rate. Fantastic result for New Zealand. The only slight problem we've got in New Zealand is there was a case of 100 workers having to isolate. So that is one risk that we do have for the New Zealand dollar. So bear that in mind. We'll look at the Euro New Zealand dollar pair. I am currently short on that pair. I'll show you how I'm managing that, what the reasons for, and I'll just run that through for you. Australian dollar, are we still going to see some sellers on deeper rallies? It's worth being aware there's a number of headwinds for the Australian dollar. We'll go through those. Pound, what to expect from the pound after last week's Bank of England meeting. I did do another post on my blog. I will send the link for you as we digest what we can expect from the last Bank of England meeting. Interesting to see what the Bank of England did last week, as they kept a more hawkish tilt, but without following through. So we'll look at the broad pound upside. We'll also look at gold, obviously, after the flash crash. And for those of you who weren't there on Friday, I was flagging selling a gold and a strong data point. I know some folks got into that dollar yen upside. It was no-brainer situation. Obviously not trading advice, but when you learn to understand these market conditions, you get to see when the turning points come. That's the beauty of trading, and when they come along, you take them, and that's the skill that's involved in that. Also look at the Aussie New Zealand dollar. Still consider that and look at that Euro New Zealand dollar outlook. So that's roughly what we're looking at. Without further ado, I'll just go over to the charts, and I'm going to start by going into the post I just made early Friday morning, just explaining, look, it's all about the NFP. If we've got 1 million jobs, and taper announcement we priced in for August, the no-brainer trade on the still of jobs is obvious. Short gold, long dollar yen. So let me that's on my Twitter account. If you're not following me at Twitter, I'll just put my Twitter handle in here. It's at Giles Coughlin at CC8. That is down there for you. It's not a capital O, but that should get that there for you. And we'll look at the charts now. Okay, dollar strength. Remember, the dollar is driven by two things at the moment: risk off trading and US economic data. The strength in the US dollar on Friday was as a result of US economic data. Now, we had a run of good data and some Fed speak that really boosted the US dollar last week. One, US PMI data surprised to the upside. Two, Fed's Vice Chair Clarida outlined the fact that she could see a case, it's not she, he could see a case for interest rates rising as early as 2022. So he moved from a neutral position to a more bullish position. We then also had a very strong NFP print, 945,000 jobs printed above the 800,000 expected. Participation rate higher. In other words, the total job pool has increased. Wages higher. Revisions included, jobs had risen by 1 million. So the jobs report was very good. We were covering this on both the service that we give to HYCM clients at Financial Source and on my Twitter handle. And this was well flagged and was easy to anticipate. These kind of moves, I think, are moves to be received. Now, we saw the dollar strength, we saw the US dollar yen push higher. Now, we had, first of all, the dollar yen pushing higher earlier on Fed's Vice Chair Clarida's speech. We then had this break of this trend line. So from a technical perspective, this is a technical break. We are expecting buyers from 110. So any retracements back down to 110 can be considered suitable for buying. Stops can be placed sub 109.50. And as long as we stay above that trend line, just stay with the trade. Looking for a first stop into 110.50 and then up to 111. So the first outlook we have is US dollar yen upside. And notice how the US 10-year yields are pushing higher. Obviously, the 10-year yields pushing higher is what helped the US dollar Japanese yen pushing higher. And as long as 10-year yields keep rising, expect that dollar yen to move up. So what we're looking for this week, and this is, take note, we want to see Fed speakers who respond to that jobs print. If we've had Fed's Waller, we've had Fed's Vice Chair Clarida, look out that they don't dial back expectations. That could be a negative impact. And look for any Fed speakers who start moving in Fed's Vice Chair Clarida's direction and Waller's direction. So sooner rate hikes, sooner tapering. We're encouraged by the last jobs report. The US economic recovery is on the way. Now, I'll show you something else as well. At the moment, the market is very much looking like tapering that earlier announcement from the Federal Reserve at the Jackson Hole Symposium. Have a look at this. This is from the Consumer Confidence Survey. So look at the full line, and that dotted green line is the unemployment rate. Do you see how expectations that jobs are plentiful causes the permanent unemployment rate to drop? Okay, so when confidence rises, unemployment falls. Confidence is at an all-time high that there's jobs around, right? Which means the labour market should catch up to demand and accelerate the labour market recovery. As the sort of job compensation schemes come to an end around September, jobs should just, unemployment should just drop. So that's what my expectations are. So I think the US labour market is very well placed. Okay. So broadly speaking, we've got dollar yen upside. I'll show you what a lot of the misunderstanding's been. A lot of people have been looking at these US 10-year yields, okay? And you saw US 10-year yields. This is the government bond for the US Treasuries. And basically, the yield rises when interest rate expectations are expected to rise, okay? And they fall when interest rate expectations are falling. Now, recently, the 10-year yields have been falling, and people are like, why are bids coming into bonds? Why are the yields falling? It's been a controversy, okay, and it's been a contested issue. Now, where should the 10-year yields be by December? Should they be closer to 0.6 or closer to 2? Well, the answer is they should be closer to 2. So eventually this dip is going to move higher. Okay, the bid into bonds is going to stop. That's almost certain given market conditions. Now, obviously, unexpected events can and do occur. I'm not saying that I can see the future, but in 6 months, where would you anticipate the 10-year yields being, 2 or 0.5? Well, the answer is they're much more likely to be at 2. So that means the expectations are that these 10 yields will move higher. Tapering, strong jobs, strong US economic recovery is what's going to push this higher. So as long as we see jobs recovering, we expect this to move higher, which means we have a medium-term upside bias in the US dollar Japanese yen pair. Okay, we have a medium-term upside bias. So expect to find buyers at 110, and look, any retracements back lowest is 109.80 would be even better value, because that's what we're expecting medium term. Now, here's an event that will help you looking ahead. Now, the main event of the week is the US CPI data. That comes out on Wednesday. Now, Fed's Vice Chair Clarida has said that he thinks that inflation above 3% is a worry and needs to be addressed, right? So what that means is that if we do see a CPI print that's high on Wednesday, then dollar yen should surge high, right? Now, if we see a miss in CPI, so say there's a disappointment, we'd expect the dollar yen pair to move lower. But remember, the key driver for US interest rate expectations is labor data. So if we see a weak CPI data, we'd expect to find the US dollar Japanese yen pair move lower, but then we'd expect to find dip buyers. So, you know, any area below this market value on a drop in CPI looks good value. Okay, so there's kind of an asymmetric risk for buying the US dollar Japanese yen pair into or out of the CPI data on Wednesday. If it's a beat, this should move higher to 110.50. If it's a miss, it should drop lower but find dip buyers, because expectations on labor is what's driving the market, and labor data was good. I hope that makes sense. Hope you can see that. It's what's called an asymmetric risk. And sometimes you get that in markets, and it's great, because the asymmetric risk means that there's much more chance of upside in the pair than there is in downside. Okay. Now, we're now going to look at the Australian dollar. Now, I'll show you what's weighing on the Australian dollar. You see these iron ore prices, right? Now, let me explain something to you. The biggest export from Australia is iron ore. 25% of all Australia's exports are iron ore. Now, why are iron ore prices dropping? For this simple reason. China needs to cut its greenhouse emissions. 15% of those emissions come from China's steel mills, which uses iron ore, right? So they're going to cut back on their steel production in order to cut back on their greenhouse gas production in order to meet their greenhouse targets. So that's why iron ore is falling, because less demand is expected for iron ore. Now, Australia, 25% of Australia's iron ore, 25% of all Australia's export is iron ore. So falling China demand for iron ore is bad news for the Australian dollar. Also, 80% of Australia's iron ore production and exports, go to China. Do you see? the problem? So that is one negative for Australian dollar. Secondly, we've got rising COVID-19 cases. They're dealing with that terrible Delta variant. We also have slowing growth in China. That's also been weighing on oil markets today. Because with slower growth in China, that's why oil markets are pushing lower. But medium term, we would expect some upside in WTI. We have OPEC Plus meeting on Thursday this week. So medium term, expect upside, and also buying oil that makes sense at market with a stop at 64.80 makes sense. Okay, that is definitely a potential. WTI could be bought at market, and stops could be placed just ever so slightly below that near-term level around that sort of 64 at 76 region. So that's definitely something to look out for going into the week. A speculative long there. Now, medium term, the demand should keep going for oil. Okay, it really should. So it's not like it's quite a good place to potentially define and limit risk with potentially quite a bit of upside. Obviously, OPEC meeting this week, they're not likely to say something that's negative for oil. They'll try and support oil prices. Of course, they could, but that's just in terms of expectations. Also want to look at the last Bank of England meeting. Now, I'm just going to see if I can find my blog. And if you look here on the blog, I keep up to date with all the central bank meetings. It's put a lot of effort into making this work. And you can see here, I'll put this link into the GoToWebinar control panel. And if you just follow that link here, you can read this article for yourself. And I'll just explain to you what's going on here in the article. Now, the last meeting, Bank of England met last week, they revised growth upwards, they revised inflation upwards, okay? Now, going into the vote, 2 Monetary Policy Committee members were expected to vote against the current pace of quantitative easing. So the vote was expected to be 6-2. In other words, 2 people, Saunders and Ramsden, were expected to say they want earlier quantitative easing shift. In other words, that was bullish. In the end, it was a 7-1 split, which was more negative. But this is the bullish factor. It's called the balance sheet. So you know how when a central bank wants to borrow money, you have quantitative easing when it wants to expand the money supply in the economy? It's called quantitative easing. Now, the opposite of quantitative easing is called quantitative tightening. That is when the balance sheet is reduced, there's less borrowing, and it's an important step for central banks normalizing. Now, the Bank of England under Mark Carney had said that they were only going to start quantitative tightening. They're only going to reduce the balance sheet when interest rates were at 1.5%. Now, Bank of England interest rates were at 0.10%. So what Bank of England's Governor Bailey said, well, hang on, if we've got to wait until interest rates are at 1.5% before we start reducing the balance sheet, we may never get there. It's ridiculous. So what Bank of England Bailey has done, he's reduced the 1.5% figure down to 0.5%. Now that's much closer. So that could be just a couple of, rate hikes. So what that means is the Bank of England is preparing for a more bullish recovery. UK, large proportion of the UK population now vaccinated. The vaccinations are largely working here in the UK. The vibes are quite good. There's been a number of people on television, criticizing those who were saying there's going to be hundreds and thousands of cases, we're going to be overwhelmed. Hasn't been the case. So cases have been trending lower, deaths are still lower. So although they've been slightly up in terms of hospitalizations and slightly up in terms of deaths, it hasn't been a terrible chaos. Now, obviously, COVID-19 is a terrible human cost. But in terms of the financial cost, it's not too bad for the UK. So that means pairs like the pound yen still make sense. Selling euro pounds, buying pound yen still makes sense. The medium-term outlook's there. Now, the thing to watch with the pound yen is if you see risk-off trading, the yen can find buyers. Okay, watch for this break. That's a key break at that level there. You can have a look at my article for more details. In terms of events, it's a quiet week. Okay, there's not much going on. Bostic speaking, Barkin speaking. So watch out for those Fed speakers. That's likely to impact the risk tone. If they start moving hawkish, expect dollar yen to start moving higher. Okay, so watch out for that. Hawkish Fed members, and what you want is you want dovish members saying something hawkish. That's what's going to give a spike in the dollar yen. Okay, listen to that sentence again. Dovish Fed speakers saying something hawkish is what's going to boost the dollar yen. And one of the services we provide HYCM clients, and I'm very proud of this service. I'm one of their key analysts here working at Financial Source. And we just, we give traders the update on all the different Fed speakers. So you can see Bostic is speaking later, and he's a hawk. Okay, so you expect a hawk to say something hawkish, and Barkin is a neutral. So the one to watch today is Barkin. If he says something hawkish, expect that to boost the dollar yen. Okay, that's a really, really, really key thing to be looking out for. Tomorrow, not much going on. ZEW economic sentiment, expect that to keep tipping higher. Just check out the Chinese data, that's not showing further slowdown in China. That could weigh on risk tone. CPI data, that's the main event of the week without a shadow of a doubt. I've shown you what the asymmetric outlook is there. Dollar yen buying, if it's above expectations, expect buyers. If it's a fall, expect dip buyers. So either way, I'm expecting dip buyers in the dollar yen. Also watch out for inflationary pressures in the PPI. This is the producer price index, and what this shows you is what the cost is for producers, and the greater the cost for producers, the more likely inflation is going to hit consumers. Okay, so this is producer price inflation. That ultimately can feed into consumer price inflation. Doesn't always. Just because it costs a company more to make something, they're not automatically going to pass that cost on to their consumers, are they? Okay, because if it's too expensive, the consumers won't buy the product. So it doesn't always follow, but eventually, sure as eggs, the costs get priced on, don't they? Right, so just bear that in mind. And quiet end of the week for Friday. So just watch out for Fed speakers. That's going to be the main thing to be looking at today for this week. And aside from that, I'll just briefly go through my Euro New Zealand dollar outlook. And yeah, let me just show you here. Now, I do like a medium-term sell in the Euro New Zealand dollar, and I'll just run through this with you. Okay. The three largest investment banks now in New Zealand, ANZ, BNZ, ABS, all see the RBNZ raising interest rates 3 times, get that, before the end of the year. Wow. So that's an interest rate hike in August, October, and November. So that New Zealand dollar strength that came into the market last week, you see it's rejecting those 100, 200 exponential moving average. It's all on that unemployment data. Unemployment was at 4%. It was expected to be 4.5%. That's a big tick for the RBNZ. And the risk is that the RBNZ, the conditions are too helpful for businesses, right? So they've got to control any undue expansion in the economy. So time to raise interest rates. The OIS futures contracts are pricing an 80% chance of RBNZ hiking. Now, remember what I said when I started? The only thing that could change this outlook, and the RBNZ are meeting like 18th of August. So let me show you. So not this week, next week, you got the RBNZ meeting Wednesday, 18th of August. So expect the New Zealand dollar to find buyers into next Wednesday. Okay, and one expression against that would be against the euro. The euro has a weak bearish outlook. Now, so I'm going to medium-term sellers. Do you see how you've got this trend line broken? Stay below, expect buyers to carry on, looking at a near-term target. Ultimately, maybe that 1.06500, potentially even close it on the spike out of the RBNZ. That's one possibility, okay? But expecting this to move lower. If you get back above, you can exit and re-enter on a break. So you can really get a nice tight stop, use that trend line, got that break on the good employment data, that's good enough, expecting further downside in the euro and New Zealand dollar pair. If there's suddenly something really bullish for the euro, you'd expect to see some euro strength. At the moment, the euro is being dragged down by the euro-US dollar pair. I'll show you one last thing, you must get this straight in your heads. The euro-US dollar pair is called the anti-dollar index. So here we go. You see this anti-dollar index? So whatever the dollar does, the euro-US dollar pair does exactly the opposite. Okay, so look at this. So you see here, when the dollar goes up, the euro-US dollar falls. When The dollar index falls, the euro-US dollar rises. They are exactly opposite to each other. So with the dollar rising on that CPI data, the euro-US dollar pair is falling. Okay, so that should weigh on the euro as well into this week. And even if there's a bit of a retracement, ultimately expecting euro New Zealand dollar sellers. The only other thing I would say is be careful of equity markets. I just saw that these equity markets are so highly priced, okay, it doesn't really make sense. The only pair that I was saying made sense for buying was the FTSE 100, just a retest of that trend line. You can see that's pushed a little bit higher. That's the only one that really made sense. Stay above that trend line, stay with it, get back below, exit. But apart from that, there's nothing else really making sense in terms of major stock markets. Folks, I hope that helps. I hope I've got you ready and I've made sense of the markets for you. Oh, great, Vitez. I'm glad you've got it. Ah, excellent. So I only just saw your comment. Let me know, is that making sense? Anything you don't know, anything you want to know? Oh, Sarah, that's a shame. Only got the last 10 minutes. Oh, I don't think I shared with you about gold and the flash crash. Right, my mistake. I said I thought I'd tell you and I didn't. Right, now this is what to look for the flash crash. You see this? Now, there's one time when a flash crash is more likely to happen, and it's after the close of the US session and before the start of the Asia Pacific session. So if you look here, you'll see when did that fall? Just after the close of the New York. So it wasn't New York, it's Sunday open, but crucially, it's before the Asia Pacific session starts at 12 o'clock GMT. Okay, so flash crashes tend to happen around that time, in that little gap. Now the reason is, you can see how that like it was basically 15 minutes of selling, right? Just a few minutes of selling. Now what happens is when the market opens, or when New York had gone to bed, and before the Asian, Japanese traders get going, what happens is that there is an absence of orders in the markets. So it means if there's a big order that comes in, I think some big sell orders did come in, and we were expecting to sell gold, and I shared on my Twitter tweet how I put that on Friday, and explained that to everyone. And that was from this region here. We had gold selling off. That was the NFP print, and that's what we're expecting gold. And I was saying, people, take profit at that 1760 region. So we hit profit, right? Now, we couldn't have foreseen this move. It's a flash crash. It's because there's not many orders in the market. And so when markets move, they try to find, and also these sellers are trying to find another order, another buy order to kind of stop the falls. And they have to skid through price. So when markets are called illiquid, you can get one of two things. You can either get like no movement or exaggerated moves. Yeah, so look out for that at the close of New York session and before Asia traders get going. That's one of the key times you can get a flash crash. Now, the other time you can get a flash crash is from the rise in algorithmic traders. Algorithmic traders will sometimes, which is the computer generated trades, if they see a strong move in markets, they'll sometimes close their orders, and they could be pending orders. So there was a flash crash in the pound not too many years ago, and it was because that there were algorithms moving. There was a large order that came into the market, and the algorithms cancelled the order. So all of a sudden, there was all these buy and sell orders in the market, and they disappeared in a second. And then all of a sudden, you had this kind of move. In other words, the market was liquid, plenty of buy and sell orders, and then suddenly became illiquid, skidding price. So quite illiquid markets when you see that. I hope that helps. Sarah, make sure you get the, yeah, check for recording, Sarah, make sure. Yeah, that's great, Vitez. You're welcome. Ibrahim, yeah, Euro Swiss franc buy. Yeah, now, like, I do like a Euro Swiss franc buy, absolutely. I am personally long the Euro Swiss franc. But remember that it is I'm long in a positional trade position, okay? So I've got a big position in terms of wide stop. So the way I'd manage the Euro Swiss franc is this. So I'm long this market. what I do, if I'm expecting in 6 months, 12 months time, where do I expect the US Swiss franc to be? I expect it to be closer to 1.2 than I do to 1.045. Swiss franc is a safe haven currency. It's bid, it's bought when markets are scared, okay? So I'm expecting the Euro Swiss franc to keep rising. Eventually, I'm expecting a faster recovery of the ECB. Eurozone, their interest rates is like 0. Swiss franc SNB interest rates is minus 0.75%. There's a divergence between the two. The way I play it, Ibrahim, is I'm happy to go long and get back below and exit and just go with the break of the trend line. So I think that's suitable to buy at market or deeper pullbacks. But if price goes back below this trend line, cut. That's the way I'd look at that. Right, you're curious about US dollar CAD. Obviously both strong at the moment, good max, but I feel some CAD strength unwinding against the US dollar. Yes, the reason for the unwinding, and first of all, excellent max. You're right, both of them had reasons for strengths, so that's really good. It's good to hear you recognize that. Look, it's the drop in crude prices. That's what's been weighing on the CAD this morning, okay? So as I said, you know, a little buy at this support level makes sense for oil, you know, but stops tight, but it does make sense. OPEC are meeting at the end of this week, Thursday, and so they should be supportive for oil prices. This is just on China slowing down, slowing demand, that's just pushing it lower. Now, that all on top of very poor jobs last week, Max. Now, if we just take a look at the Canadian jobs report, you will see, just go back to last week, it was released the same time as the NFP, and that's what gave me a US dollar CAD upside bias in the pair, was weak jobs. And you can see here that the Canadian jobs, unemployment rate up, employment change down, 148 expected, came 94,000. Now, the only thing I'd say, Max, is that 80-odd thousand of those was full-time. So that's quite good. So even though it was a miss, it was a good miss, if that makes sense. Now, on your basis, what you're saying here is I think that unwind that you're mentioning, so you've acknowledged you're seeing a little bit of US dollar CAD downside, a little mixed picture in the US dollar CAD. For me, look, if you've got the choice of trading the US dollar CAD or the US dollar yen, it's a no-brainer, Max, because I am expecting upside in the US dollar Japanese yen, but there's reasons for both US strength and Canadian dollar strength, even though there's near-term weakness in the Canadian dollar because of falling oil. And remember that the US dollar CAD pair is 96% negatively correlated with oil. So what that means, let me just show you. All right, let me get rid of that one. Right, what that means is if we just invert the scale, is that, you know, you're going to, as oil moves higher, okay, and then that correlation has broken down recently. But if you look back here, you can see that as oil price moves down, US dollar CAD moves higher, okay? So falling oils, falling CAD, rising US dollar CAD, it's broken down a little bit with the recent COVID-19 supply issues, okay? But you can still see it, like, as oil drops, US dollar CAD rises, okay? Oil dropping, that gives a bit of US dollar CAD strength. Okay, so you can see it's just pushing higher, but the correlation is broken down. It's not as strictly as it usually would be. So if I show you, you see the scales inverted, you see that when you invert the scales, it's very close, negative correlation. Broken down a little bit recently, but, you know, because like Canada's biggest export is oil, and the majority of that goes to the US. So that's why you get that negative correlation between US oil and US dollar CAD. So even though this hasn't been the best example, and I apologize for that, Max, but what you need to know is that oil prices impacts the US dollar CAD pair disproportionately. So falling oil gives US dollar CAD upside potential, but oil has now stopped because it's just hit that key support level, right, that we've targeted here, right? I hope some of that makes sense to you, Max. Sorry that wasn't as clear as it should have been. Yes, that's right. There's a lot of good news already priced in with CAD, so it's now sensitive for misses. It was mainly that jobs. So that jobs report was a bit weird, but it's not as bad as you think, Max, because some of the jobs was full time. So for me, like, okay, the US dollar CAD is not a pair I'm looking at trading, you know, when I've got the US dollar Japanese yen to trade. Do you see what I mean? But yeah, it's a good observation, Max. Yes, Max, you're right. If stocks start crashing, that will feed the yen. So that's one of the risks with the US dollar yen outlook. It's the risk with the New Zealand dollar yen. It's a risk with the pound yen upside, is that if stocks start crashing, then the yen will find bids. So it's a risk that you need to be aware of for sure. Good, Max, it's good to have you. Excellent. Okay, folks, been an absolute pleasure. Thanks for joining. And don't forget, for HYCM clients back here on Wednesday, same time, look forward to taking us through. And I hope you have a very good week. Look out for that CPI data, look out for Fed speakers, and look out for any sharp moves in the US dollar Japanese yen. Take care now. Thank you. Goodbye.